business. There's a business that you invest $1 and you get back, call it 62 cents.
Yeah.
That's a bad business.
That's a bad
you don't
business.
want to be in that business.
We're Compound Everything, and we talk about markets and investing. We're two self-taught investors who pass on what we have learned, try to condense it down. And today we are talking about return on invested capital, or ROIC.
Yeah. So this was fun, actually. I really enjoyed diving deep into this. I guess, how did we come to look at this as a metric?
Doing a deep dive on it. Everyone looks at ROIC, or most people would look at it. Okay, so we came to it because Warren Buffett said that CEO has 3 jobs. And then he condensed it down and said he actually might only have 1 job. And that job is, or one main job.
Yeah.
And that job is allocation of capital.
Right. That's the main job of the CEO and the
according to Buffett.
Yeah.
And I think Buffett and Munger said they have 2 jobs.
Right.
And the first one they said
is allocating capital. And then the second is motivating their managers to keep working for them.
Right.
Even though they're wealthy.
Yeah. So ROIC, of course, is a metric that you can use to see how management is, in fact, allocating capital. So what is exactly ROIC?
All right. So basically, a company creates value for its shareholders when the future cash flow, or the present value of the future cash flow it's going to create, is greater than the opportunity cost of those investments. Right. All money costs something for a company to get. So whether it be through selling of shares or raising of debt, so you can go into the bond markets, things like that. So they can either borrow money or they can obtain money by selling their shares.
And there's a cost associated.
There's a cost associated with that. And shareholders and lenders are going to demand a return for giving that business their money.
And you don't want to find a company that is their return on their capital is coming in at less than the cost it was to obtain that capital. That's a bad business.
So Warren Buffett talks about 3 types of businesses regarding return on invested
And this
capital.
was around, what year was that? I don't even remember.
He said 2007.
I think it was the 2007 letter that he referenced 3
types of companies. So what are those?
So there's the business. So the absolute best kind of business is a business that doesn't need a lot of capital and they can generate huge profits.
Right.
So of course he uses See's
Candies
as his example. And then the second business, he says it's not extraordinary, but it can be excellent, does require a decent amount of capital, but they also generate handsome returns on the capital that they need.
Right.
And
so they're spending money, maybe increasing amounts of money, but they're generating a decent return on that money.
So he used flight safety as that example. And then he said the third type of company, and this is the kind of company that we want to avoid, is a company that they are very capital intensive.
Yeah.
And they do not generate a great return on that capital.
Right.
And he used airlines.
Airlines are the example.
Yeah. And I kind of chuckled when I read that because this letter was written ages ago, and they're all running together in my mind. But the most recent one was 2007. Right. The earliest one was the 80s, and they're running together now. But, I mean, in 2020, he bought airlines.
He bought airlines again.
And then sold them
He's described himself as an airaholic.
Yeah.
So, anyway.
So it was funny to me when I read that because he hasn't learned his lesson yet.
Right. So basically, there's businesses that all businesses will have to invest. So the amount of money they have to invest, and the amount of return that they're achieving on those investments becomes important.
Right.
You could really define return on capital businesses in other words in 3 other ways too. So one would be the one that generates more than $1 for every $1 invested.
And that would be the extraordinary.
That would be an extraordinary business. There's the businesses that generate $1 for every $1 invested.
And that would be an okay business.
That'd be okay business. You're not gaining, but you're not losing. So the business is getting bigger, but they're not generating more money for every $1 you put in.
Right.
And then there's the bad business. There's a business that you invest $1 and you get back, call it 62 cents.
Yeah.
That's a bad business. You don't want to be in that business. Yeah. So what does that mean? Let's take an example. So you have an example of a business, let's say that you invest $100,000. Okay. So you invest $100,000 and then it generates $5,000 forever for you on that $100,000. Sounds not bad, right? So you're generating 5%. But their opportunity cost is 8%.
Right.
Okay. And so if you do what's called a perpetuity formula, then you would derive that dollar amount that you've invested, $100,000, is worth $62,500. Bad investment.
Right.
So you're getting less than you put in.
Yeah.
Okay. If you take business 2, they've invested $100,000 and they're getting $12,000 on per year,
right,
forever. So if again you do a perpetuity formula, so basically you just take that $12,000.
So perpetuity means just to make it basic.
The perpetuity is just basically where that is the value of cash flows forever, basically. So all you do, it's a very simple equation. In this case, all you do is take that 12,000 and divide it by 8%, which is 0.08. And at that point, you derive $150,000.
Much better investment.
Much better investment. Exactly. So you're generating, more than $1 for every dollar you've invested. So 2 businesses, both making investments with very different outcomes.
Yeah.
So we've got 2 businesses investing money at very different outcomes.
Yes.
Now this is a pretty simple example. Very few businesses are perpetuities.
Yeah, it's simple, but sometimes the best way to look at it is in simple terms, because it gives you the idea as to why it is important. I think there are quite a few people who start out in investing and they hear all these metrics like PE, ROIC, WACC, and they look at them and they kind of know, but they have no idea why it's important. They just know, I want the ROIC to be 12% or greater. But why? Right.
Well, so for simplicity purposes, go back to my example. So the example in the first business, they were generating 5% returns, which isn't maybe bad, except that it's costing them 8% to get that 5%. So it's bad. So you get negative returns.
Yeah.
The second business, it's costing them 8% to get the money.
The same thing.
Okay, same thing, same cost, but they're generating 15% on that money. So it's easy. You take 15% minus 8%. You've got it's greater. So what the finance people will say is the return on invested capital has to be greater than the weighted average cost of capital
by 2%.
By at least 2%.
Kind of their benchmark.
Yeah. So
if a company has a ROIC greater than 2% of their WACC, they say that's a good business.
Right.
Yeah.
So we'll take it another step simpler from our own personal experience.
And did you say WACC is weighted average cost of capital?
Yes, I did.
Okay.
Yeah.
So ROIC is return on invested capital, and WACC is weighted average cost of capital, and they kind of go together.
Yeah. Well, and again, think about it like this. Weighted average cost of capital is essentially what it's saying is money costs the business something. Right. And going back to that. So whether it's borrowed money or finance.
And that's something that I never thought of, really.
Yeah,
right? Like a lot of times I would just look at ROIC alone.
Right.
In solid. It was just a solitary number.
Yeah.
But capital does cost a business something. Capital costs an individual something. Right. Capital costs a business something. That is important because you have to get over that hump of the cost before you even start to see a return.
Right. Yeah.
Right. So you cannot just, you can't just look at the return and say, they got 8%.
Right.
What did it cost them?
What did it cost them?
You have to take that out.
It's a comparison. Yeah. So on the one hand, every investors, and go back to what Buffett and Munger do, they have to allocate capital. So their benchmark is the treasury bill. So the risk-free rate. And so they're comparing everything to that. So if they can obtain 5% on a risk-free basis by just lending their money to the government in the form of T-bills.
Which is very safe.
Probably
the safest investment in a good country.
Right, exactly. It's pretty much guaranteed. Okay. And they could find a business that's generating 5%. They're not going to invest in that business. Because why would you go with a business that potentially could go under and other things may happen when you can get a risk-free rate of 5%?
Right.
Okay. So the investor is always comparing alternatives. And that's in part what the return on invested capital is allowing you to do in essence as well.
Right.
Go back to the example. And you can think of this in simplistic terms. We can use an example from our own lives. We, a while back, bought some farm property. And so we examined the borrowing rate at the time and the rate that the farm was generating rent. The interest rate on that borrowing was less than the rent that was obtained from the farm. That was being obtained and the cost. So it was a good deal.
It was easy.
Right.
And I think it was easy because it was personal.
Right.
I think sometimes when people look at businesses, what makes it difficult is it's not personal. But if you can look at it as if it was your own bank account, it would be more understandable to a lot of people.
Right.
Because we went to the bank, we said we need X amount.
Yeah.
We have this.
Right.
Whatever down payment, we need this much. We knew the rate, we knew what the farmer was going to, it was easy, it was simple. right? But when you look at a business, you get bogged down because of two reasons, I think. And one is you're not doing it.
Yes.
So you're not thinking through it like that. And two, the numbers are huge.
The numbers are huge and they're complicated.
And they're complicated, and those huge numbers are intimidating.
Yeah.
Right? But they're the same numbers, just with more zeros. It's the same, I should say, they're not the same idea. Numbers. It's the same concept.
Yeah.
Just more zeros.
Just more zeros. And maybe a few other little things put into it.
Right.
It's not out of the realm of grasping for the average investor.
Right. And as for the motor, and what did he say? And this is when we were looking at our farmland, one of the reasons why, because we made that decision pretty quickly.
Yeah.
When that land came up, and we weren't actually actively looking for farmland.
Yeah.
That was the thing. We just stumbled across farmland that came for sale, and we were able to make that decision within a day or two.
Right.
Because you had heard Ashwat the Motor.
And I'm going to paraphrase him. He said basically, if the return on investment is greater than the cost of capital, you do the deal.
You do the deal. Yeah. And that was it.
And that was it. Like, okay. And it's worked out well.
Yeah.
So what is return on invested capital? What's the definition? So essentially what return on invested capital is, and I'll give you the formula real quick, it's the net operating profit after taxes and divided by the invested capital.
Right. They call
That's all it is.
NOPAT.
NOPAT. So NOPAT divided by invested capital. That's it. Now these numbers are readily available, but the problem with calculating it is that there's a fair amount of numbers that go into each of those subsegments. So and you can calculate that two ways.
Yes.
Now, we can put a little link to an article we found that explained this, in my opinion, fairly well. It's somewhat technical.
Very well, but it was very academic.
It's very academic, very technical. Article by Michael Mobison, and it's called Return on Invested Capital, How to Calculate ROIC and Handle Common Issues and it's Morgan Stanley article.
And just anyone who is new to investing, just know
it's technically difficult.
Very academic.
Yeah.
Right? This is not written for someone who's decided to start investing yesterday.
No.
Yeah.
So, but it is
But it's
good.
still very good, and we would recommend that you
would recommend you read it. Now, you can look through that and calculate yourself, and you probably should understand the fundamentals and how to do that. But there is websites that you can go to as well that will actually calculate it for you. Now, whether you trust those websites or not is something else. Also,
because they don't tell you. None of those websites really tell you. So
how they've calculated it.
So we use Value Line and ROIC.ai.
Yeah.
Actually, and we like that one better than Value Line.
It's a really good website. Here's a little plug for the website. Yeah, we have no financial disclosures.
We have no idea who runs it. Very affordable.
But they do a great job.
Yeah, very affordable. But one thing you don't know is how do they calculate ROIC? I mean, you know how they calculate it. You know the equation, but you don't know exactly, especially on the invested capital on the denominator side, you don't know exactly, are they taking cash and cash equivalents out, are they leaving them in? So go ahead and talk about the two different ways.
So basically you can calculate return on invested capital two different ways, and this is because there's something called the balance sheet. So everything has to balance on the asset side and the liability side of the balance sheet. You can do it through the operating approach or the financing approach. And the article that we referenced by Michael Mobison does a great job of breaking that down. I don't think I can do a very good job of explaining it. You probably have to see how it's done.
33 pages.
It's 33
43
pages.
or something like that if you include all the footnotes and references.
Yeah. But know that you can calculate it a couple different ways. At the end, you should obtain the same result.
And that's why, and the reason we say you can calculate it a couple different ways is because that's why it is good for you to understand and know
the mechanics.
Because if you want to do what they call your due diligence, to just take a number off of a website and you don't know exactly what they're doing it, that's not probably true due diligence.
Due diligence, yeah.
Right?
So the point being is know the mechanics, know how it's done, and see whether you trust websites that spit these numbers out at you.
Because one thing Michael Mobison says is that he would recommend taking cash and cash equivalents out.
Right.
And a lot of people don't do that. And why does he say that?
Well, he says that because you want to, in order to be a purist, let's say, you want to calculate the invested capital of those things that are fundamentally required to run the business.
Right.
So if you have a business that, extrapolating that, if you have a business, and we'll use two just as examples, and I don't know what their exact cash and cash equivalents are, et cetera, but let's say you have Lowe's and Home Depot, very similar type businesses, right? Let's say though that Lowe's and Home Depot are generating identical returns on invested capital. You might be unduly punishing one of them if they have a lot of cash and cash equivalents, because that money is not being used or deployed effectively.
And all of a sudden that denominator gets really big.
Right.
Yeah. And it changes your whole number, but meanwhile they don't actually need that cash.
Yeah.
In order for the everyday dealings of the business.
Yeah. So if one of them has an inordinate amount of cash compared to the other one, you may be kind of comparing apples and oranges to a point.
Right.
So they deduct, cash and cash equivalents, marketable securities, and things like that. Now, people may have reasons why they want to keep that in there, and that's to their own devices, but whatever. I thought of taking two examples, actually.
Okay,
so
sure. And those last examples, Home Depot and those were hypothetical numbers.
They're hypothetical. I have no idea. Although I'm going to use Home Depot again in my example. But why use return on invested capital? So we mentioned that you want to find businesses that are generating positive returns.
Right. And you want management who's properly allocating capital.
Right. So if you take return on invested capital, you can take those numbers and compare them to businesses within the same industry to see how the management's actually performing. Then the other thing that you can do is gauge over time how the business is performing.
Right.
Now, look at Kraft Heinz. Okay. So Warren Buffett thinks that Kraft Heinz is losing their moat.
And I think he admitted to overpaying.
Yeah, he admitted to overpaying for it.
Recently,
and he used the example of Costco at one point.
Yes,
and
he did.
Kirkland and these store brands. So he said Kirkland brand is really not perceived much differently than Kraft brand in many cases. It's kind of chewing into their returns.
Yeah.
And if you look back at the frank numbers for Kraft Heinz, back in around 2011 to 2013, which were the farthest numbers back, and these are the numbers I just kind of quickly obtained from our
We didn't run our own numbers here. Now here's the thing, in this particular case, because you're looking at the same company, right? That website is going to find that number the exact same way.
Exactly.
Right?
So it's going to be internal consistency.
It's going to be internal consistency. So it's a little different than when you're actually comparing companies to each other.
But the funny thing is, so if you compare back to 2011, so this is about 11 years ago, 12 years ago, or 10, 11 years ago. So between 2011 and 2013, the return on invested capital for Kraft Heinz was between 9 and 15%.
Right, which is a good return.
Which is decent. Yeah. Generally, we'd like to see them over about 12 to 15%. But 9 to 15% is not bad.
Yeah,
so more recently, though, over 2020 and 2021, it was down to 3.1% and 2.7% respectively. So you can see the return on invested capital has gone down. So they qualitatively they've lost their moat. So if you go to the store, you can see the Kraft brand and the Heinz brand are not much more than the house brands.
If sometimes they're cheaper.
Sometimes they're cheaper.
It's wild.
Yeah.
It's wild to watch. So, and this is where Scuttlebutt comes in.
Yeah.
Because even without looking at their ROIC, even if I had no idea, if I didn't do my own investing and I wasn't interested in studying business, I could tell you, just as a shopper and a mom who buys a lot of groceries, that Kraft Heinz was not the same company it was when I was a kid.
Yeah.
Because Kraft dinner is always cheap.
Yeah.
So my kids hate homemade stuffing. So on Thanksgiving,
we bought
stovetop because they actually asked for stovetop, and it was 88 cents.
You can't make stuffing for that.
88 cents for a box.
I don't think you can't even buy a loaf of bread for that.
If I was in America, that'd be like 60 cents a box or something ridiculous.
It's insanely cheap.
So even if I hadn't looked, or if you hadn't looked, and you said, "Hey, do you think the ROIC has gone up or down on Kraft?" Right away, I'd be like, "Oh, it's gone down because they've lost pricing power."
Yeah. So let's take another company. So we've compared those. Home Depot. We'll go back to Home Depot. I said I would.
You love Home Depot.
I love Home Depot.
Now, do you have an investment in it?
I do not.
Okay.
I'm definitely looking into it though. So Home Depot, if you look at Home Depot, so back in around 2009, 2010, they were generating returns on invested capital between 8 and 10%.
Okay.
And now keep in mind, this is just after the great financial crisis. Right. So people were probably having a little less money around. And
you weren't doing big kitchen renovations,
bathroom
renovations, all that.
And it's gone actually steadily upwards since then. And they've been achieving returns on invested capital between 30 and 40% over 2020 and 2021.
That is crazy.
It's huge, right?
Yeah.
So there's something to them. So both Lowe's and Home Depot have actually quite good returns on invested capital if you look at them. And certainly from where we are, they have a significant moat. Really, they're the only two hardware stores
with a few little mom and pop shops
with any substance. There's one other that may be a distant competitor.
Maybe, yeah.
But a few mom and pop shops, but they take the lion's share. There's no question.
And again, like just being a shopper.
Yeah.
You could say, because a company needs to protect a moat, just like a castle, right? Like a castle had to protect it, and the better the moat and the bigger the moat, the more protected the castle was, right? And it's just like a business, and you can see that Kraft was not protecting itself.
Right.
It got lazy.
Yeah.
And their moat got shallower and shallower and narrower and narrower.
Yeah.
And you can see Home Depot's is getting bigger just by watching the businesses,
Yep.
not even looking at the numbers. So because you used Kraft Heinz and Home Depot, now I don't do a lot of shopping at Home
Sure.
Depot. You drag me out to it, but I kind of just walk.
You like the result of Home Depot.
I do. I walk around just following you on my phone generally, but you know, it's always busy.
Yeah.
I mean, we are always there. I feel like everyone's always there, right?
We've
like,
dropped thousands and thousands of dollars at Home Depot.
Right, and then there's Kraft.
Right.
And it's like no mom, no family, you know, Kraft isn't a big deal. Back when I was a kid.
Used to be.
That's what I'm saying. Back when I was a kid, if you had Kraft dinner instead of mac and cheese, Kraft dinner was like, right? Same with like their dressings, Kraft dressing.
Sure.
Just Heinz ketchup, right? There's a pricing power and there's not a pricing power there anymore. Home Depot, things have definitely gotten more expensive there.
Yes.
Because you'll be like, what? This is this much now. So like, but we still buy it. So they have a pricing power moat, and
we don't have an option.
We don't have an option. We have to buy it, right? So Warren Buffett has said that there are two ways that a company will have a high ROIC.
Okay.
So that's why I'm kind of going down this path. And one is pricing power.
Yes.
They have the ability to raise prices without losing customers.
Right.
And two is a turning over very quickly of its
inventory. Yeah.
So, of course, we can see Kraft Heinz, they do not have pricing power.
No. Well, and like you said, in fact, oftentimes with Kraft Heinz, the Kraft Heinz, let's say barbecue sauce, is actually much lower cost than like a house brand. So they've lost pricing power.
Well, even things like Jell-O, like who eats Jell-O?
We don't eat Jell-O.
Like, I don't know. I mean, maybe if you eat Jell-O, I'm sorry.
Yeah.
But I like, that was our grandma. Like, my grandmother always made, like, it was disgusting.
And pudding and all that kind of
stuff.
stuff.
Like,
no
my
one makes
grandma
that
made
anymore.
this Jell-O salad. It was so gross, and it had fruit or something in it. I'm like, what is that? But, like, Jell-O, like, who eats Jell-O?
Apparently nobody. That's why the returns have gone down.
but yeah, so Kraft. But there was a time where it was like, oh, Jell-O.
Yeah.
Right? Yeah.
Yeah, so pricing power is key.
That's the thing. Pricing power is key.
Let's look at another company that you love, Lululemon.
Yes, I do love
Lululemon, right? So Lululemon, they have pricing power.
I'm wearing Lululemon right now.
You are, right. And you go...
I wear it every day.
You go to Lululemon and you will spend
I'll give my
$30 or $120 on a pair of tights.
Of course.
Right? Because they're different.
Well,
right?
here's the thing. I have tried other tights.
Yeah.
I have tried cheap tights. I've tried like going to like Garage Clothing and trying like cheap. They're horrible.
Yeah.
I've tried higher end tights. I've tried Aritzia tights.
Mm-hmm.
Nothing compares to Lululemon. I have found one bodysuit, and even then it's close, but it does not breathe the same as Lululemon.
And even their men's clothes. I love their pants.
And they're amazing.
Their pants are amazing. And so, would you guess what is their return on invested capital?
So I've never, because I'm not invested and I don't follow them closely. I just love them as a store to shop at. I'm going to say that the return on invested capital is wild, and
it's consistently between 20 and 30%.
Yeah, that does not surprise me.
Very good. So
their stores are always busy.
Right.
Their pants have gone from I think when I first started buying them, they were like $70. Now they're $130. And here's the thing, I don't care.
Right. And they have pricing power. They can raise their prices, and they have raised their prices over time, and people still keep coming back and paying.
Yeah.
Right. And so hence why they can keep generating the handsome returns they have. Now, it's up to the investor to determine, A, what price should I buy the stock at? The return on invested capital being high does not mean it's a good value.
It does not mean that any price is worth paying.
Right. There is a time where even those generous returns are not worth paying for at a certain price.
Right.
Price is what you pay, value is what you get.
Right.
If you are a true value investor, you want to get value for what you're paying.
And if a company has ROIC, and especially if that ROIC is 2% or greater than its WACC, the market is going to
recognize that and give it a premium.
That company a premium. So as value investors, you can't just jump in. Often you might have to wait for an event bad news, or maybe a shifting of management. People don't like that.
Yeah.
You'll have to wait for some reason for the company to be improperly punished.
Yep. Another one is Starbucks. Starbucks has a consistently high return on invested capital.
It's to the point that I don't even want to buy a coffee there anymore.
It cost us $7 yesterday for a coffee.
And that's for me to be I'd rather go to McDonald's.
Yeah. But there was a lineup of probably 24 people at the Starbucks we went to yesterday, waited 20 minutes for a coffee.
So we did go, and part of why we went is because, I want to do. And the other part was because we wanted to watch and see how much money they were making every 5 minutes.
Just guesstimate.
So we stood in line and timed it and counted the cost, like watched people leave with their orders, and they must have been making like $150 every 5 minutes.
Yeah.
Between mobile orders coming in and the people
as a rough estimate.
As a rough estimate.
Yeah. Oh, they shipped out at least 20 drinks in the 5 minutes we were
And that's pricing power. Like you look at all those people in line, and not one of us, no matter how much money we make, should be spending $7 on a call.
And waiting 20 minutes for it. No question.
Not leaving angry about it.
No, everyone was happy. They left with a coffee in their hand and a smile on their face.
Right. So
a company like that generates a high return on invested capital.
When Buffett says pricing power is one of the best ways a company can, he means it.
He means it, for sure.
And part of that is because if a company does have pricing power, it's because they have a cult following.
Right. So, and we see that in Lululemon, we see that in Starbucks, and whatnot, Aritzia. So the bottom line is a company has to have a moat. And they have to be able to protect that moat in order to continue to generate those high returns of invested capital.
Yeah.
So can they do it becomes the question for the investor.
Yeah, and just because they have done it does not mean they will continue to do it. And Kraft, again, is an excellent example.
Of a company that had it and lost it.
They had pricing power, right? Moms would be like, oh, should I just buy the no-name version? Or right? And they lost that. And it kind of happened overnight.
It happened quickly.
It happened very fast.
It did happen quickly.
Yeah.
So I guess to summarize at this point, high returns on invested capital are what the investor is looking for.
In comparison to
other businesses in the same industry. Now, a little bit of a side point, it's not fair necessarily to a business like Kraft Heinz to compare it to a software business.
Oh, yeah.
They're very different businesses. And oftentimes software businesses will generate significantly higher returns on invested capital.
And I think Ashwath Damodaran actually does do an updated sector review. Like, what is the average return on invested capital for each individual sector? And I think he updates that every year.
Yeah.
So if you find that, you'll kind of know, like, for software, it's very high. For oil, it's very low.
Right.
Right.
For
so
sure.
You can't compare software and oil because
they're very different.
Very different industries. Yeah.
So you're going to want to use return on invested capital for a few things. One is to determine whether they're generating more than $1 for every dollar they're investing.
Very important.
Yeah. Two, you can use it to monitor potentially on a quantitative basis the durable competitive advantage that your company has. And thirdly, you can compare it to other companies within the same industry to determine how good your management is at allocating capital.
Yeah.
So that's a pretty long summary of what return on invested capital is.
Yeah, so that pretty much summarizes it. We really went off-roading there for a little bit.
Yeah, I hope that was helpful. Huh?
Yeah, it is really fun when you can look at a business and you know as a consumer that, oh, this company has a moat or this one doesn't. And then you look at the numbers and you find that
they tell the story.
And they tell the story.
That was cool.
Numbers do tell stories. And again, Damodaran says the numbers are easy to find. It's the story that you have to figure out.
Yeah, that's right.
Right? And so this was kind of a very fun exercise for us. Again,
Definitely.
we'd recommend that you read that article by Mobison. I think that's how you say his name.
Michael
I'll
Mobison,
try and link it in the notes. Never done that.
Okay.
In the show notes.
Can you put that link to Ashwath Damodaran's
I'll also
website
try to link as much as possible. So that wraps up everything. I hope this helped, and we will see you next week.